We all need them. Things like oil, gold, and wheat. These are commodities. Commodity investing is buying and selling these raw materials. Why invest in commodities? They can be different from stocks and bonds. When stock prices fall, commodity prices might rise. This makes them a good way to spread your risk. Commodities are traded on exchanges. Think of it like a giant marketplace. Buyers and sellers come together to agree on prices. Investing in commodities can be complex. It's important to understand the risks and rewards before you start. Individuals have several options for investing in commodities. One way is through futures contracts. These are agreements to buy or sell a commodity at a specific price on a future date. Another option is to invest in commodity ETFs. These are exchange-traded funds that track the price of a specific commodity or a basket of commodities. Individuals can also invest in commodity mutual funds. These funds pool money from multiple investors to buy a diversified portfolio of commodities. It's crucial to remember that commodity prices can be volatile. This means they can go up and down quickly. Don't invest more than you can afford to lose. Companies that use commodities in their production process often invest in them. For example, an airline might invest in oil futures to protect against rising fuel costs. This is known as hedging. Companies may also invest in commodities to speculate on price movements. They hope to buy commodities at a low price and sell them later at a profit. Large agricultural companies might invest in commodities like corn or soybeans. They use these commodities in their products and aim to secure stable prices for their raw materials. Corporate commodity investing can be risky, especially when speculating on price movements. Companies need to have a sound risk management strategy in place. Section 4. Individual versus company. Comparing commodity investment strategies. Both individuals and companies can benefit from commodity investing, but their approaches differ. Individuals typically invest in commodities to diversify their portfolios and hedge against inflation. Companies, on the other hand, often use commodity investing as a strategic tool to manage their costs and ensure a stable supply of raw materials. Individuals may find it easier to access commodities through ETFs and mutual funds. Companies, with their larger resources, may engage in more complex investments, like futures contracts. Both individuals and companies need to carefully consider their investment goals and risk tolerance before investing in commodities. Section 5. Commodities as a safe harbor in economic storms. During economic downturns, traditional investments like stocks and bonds often lose value. Commodities, however, can act as a safe haven during these turbulent times. For example, gold is often seen as a safe haven asset. When the economy weakens, investors tend to flock to gold, driving up its price. This is because gold is considered a tangible asset with intrinsic value. Oil, while subject to price fluctuations, can also hold its value during economic uncertainty. Demand for oil tends to remain relatively stable, even during recessions, as it's essential for transportation and energy production. By including commodities in a diversified portfolio, investors can potentially mitigate losses and protect their wealth during economic downturns. Section 6. Commodity Investment Success Stories, Real-World Examples. One famous example of successful commodity investing is the story of George Soros. In 1992, he made $1 billion profit by betting against the British pound. He correctly predicted that the currency would weaken and bought a large position in gold, which soared in value. Another example is the case of John Paulson, who made billions by betting against the U.S. housing market in 2007. He used credit default swaps, a complex financial instrument, to profit from the decline in housing prices. These examples highlight the potential rewards of commodity investing, but it's essential to remember that such successes are often accompanied by high risks and require specialized knowledge. Section 7. Weighing the scales. Benefits and risks of commodity investing. Commodity investing offers potential benefits including portfolio diversification, inflation hedging, and potential for high returns. However, it also carries inherent risks. Commodity prices are volatile and can fluctuate wildly due to factors like weather patterns, geopolitical events, and changes in supply and demand. Investing in commodities requires careful research, understanding of market dynamics, and a well-defined risk management strategy. Before diving into commodity investing, it's crucial to consult with a financial advisor to determine if it aligns with your financial goals and risk tolerance.